What's up, guys? Welcome to the final property market update for the UK of the year. Guys, it has been one hell of a year, hasn't it? We've seen record demand that we haven't seen for over 20 years. We've seen an average annual growth in the UK property market of over 10%. And when you compare this to the average over the last 10 years of 5.6%, effectively doubling, this really is unprecedented. And guys, years like this really don't come round often at all, once every 10 to 20 years. So over the course of me doing these updates over the last 7 months, I have learned just as much as you guys. It really has been just as much as a learning curve for me as it has for you. And we've been on this journey together, guys, in terms of understanding how the UK property market works. And this month is no different. So if you remember, if you've watched last month's update, we had a growth of 1.8% in a single month. And as I said, to put that into context, the average annual growth over the last 10 years is 5.6%. So we saw a third of that effectively in 1 month.
Jesus Christ.
Mad. And I did indeed make a bold prediction. I said, hey guys, strap yourselves in. We're about to go to the moon with the UK property market. We're about to get some boom pow action, and the property market is about to take off. Now, in front of you, you can see that over the past month, we've actually seen a contraction of 0.6%. Now, I do think that the property market is still going to have a really robust year next year, and we'll come on to why further on. However, again, I've learned yet another thing during my journey, and that is that towards the end of the year, traditionally, going into the festive period, the property market goes into a kind of Odin sleep for all of my Marvel fans out there, and it cools down. And you guys know me, I've got some data to support this. So this is from the HM Land Registry, and what this graph here shows is the sales volume throughout the last 6 years. And there is a pattern here that I want to draw your attention to. So at the end of each year, what you see from roughly November to January is a dip in the volume of houses being sold. There's less activity. People coming into Christmas are focused on Christmas. They're focused on buying presents. They're focused on making their Christmas plans. Whose house are we going to be at for Christmas? What's the logistics going to be? Doing your food shop, planning the day, buying presents. Or if you're like me, visiting a petrol station on Christmas Eve at 11 p.m. because you left it to the last minute. But back to this. So from November to January, you can see that there is a drop. November to December, fairly steady, and then you see this drop in January, and then this rebound in Q1 of the next year going into 2016. Let's have a look at what happened in 2016. Again, November to December, fairly steady, and then you see this drop and then a rebound going into Q1. Same thing in 2019, you see that drop, and then we fast forward to, let's go to 2020, the most recent year. Again, November to December, fairly steady, and then this drop going into January, and then a rebound in Q1 of 2021. And as you would expect, this is also reflected in the percentage change in prices. We just saw the volumes, i.e. the number of houses being sold. This is what's happening to the price. So you see this drop over the same period, and then prices rebound coming into Q1. And let's fast forward to 2020. You see this drop in prices going into January, and then that rebound in Q1. And the data here reflects this, guys. We have seen a contraction in November, and what's going to happen going forwards? Let's make another prediction. And I have gotten, I say, better at making predictions over the course of making these videos, more refined, learning as I go along. But based on the data that we just saw, contraction in November, the graphs that we just looked at showed us that this contraction will probably continue into December and January, and then as we get towards February, March, we're going to see a rebound. So that's what I would expect to see, just because this is what we call a seasonal pattern. Regardless of what's been happening in the year, in the run up to Christmas, whether it's this year, whether it's 2020, 2018 or 2016, there seems to be a consistent pattern in the UK property market. So based on past data, I'd expect it to happen again. And let's look at some data for the average asking price trend. So this is the average price of a property in the UK over the past 12 months. Let's start at January. So in January, we started off at about £318,000. And over the course of the 12 months, look at this graph. It has consistently climbed each month with slight lull in August, very slight, peaked out in October. And this is the first month when we've seen a material decrease. So properties this month on average are cheaper than they were, very marginally, by the way, guys, cheaper marginally than they were last month. But overall, let's look at the bigger picture. January was at £318,000. By November, we're at round about £343,000. Guys, that is one hell of an increase. If you started your search in January and say you hadn't found a property until November, you know, it'd been a tough year, stuff has come up, takes a while to find the dream property. Hopefully not 11 months for most of you, but hey, it happens. But you started your journey at the beginning of the year and you had a certain amount of money saved in your pocket, ready to buy when the right house came along. And then 11 months later, those houses that you were looking at the beginning of the year have shot up by 25 grand on average. That is madness, guys. It's absolutely crazy. You're either going to have to pray to God for a miracle that you can bridge that gap, rob a bank, or look for cheaper houses. But yeah, don't underestimate, guys. Don't sleep on the year that it's been in the property market. And also, let's look at some of these figures on the average time to secure a buyer. So what are we talking about here? This is really a proxy for demand. So back in January, if a property came to the market, on average it would take 65 days, basically just over 2 months to sell. You fast forward to October, that's almost halved down to just over 1 month. So this is an indication, guys, that there are a lot of people looking for houses, looking for properties, looking to move right now in the UK compared to the beginning of the year. Demand has kind of flattened out actually over the last, I'd say 3 months. We're basically on the 36, 37 mark. The big decreases came from January to round about the summer of June. And we'll talk about this in more detail. And we're going to link this to some more predictions for the future in terms of where I think the property market's going to go in the new year. So demand has fallen over the course of the year. Supply, on the other hand, so this is a proxy for supply. This is the average stock of property per agent. So how many properties on average does an agent have to sell? If we start at January 59, this has come down by just under a quarter to 46. So this is telling us that the amount of houses being sold or available to be sold has fallen over the course of the year. So supply is low, demand is high, and that has been a big reason for the growth in prices over the last 12 months and really the last 18 months since the global health crisis began. And my favorite parts of these presentations, guys, let's look at what's happening on a regional basis throughout the UK. So we saw at the beginning, the overall average price of houses across the UK has fallen this month. And in line with that, we would expect to see most of the regions, or a significant number of the regions of the UK, to have fallen in prices over the last month. And we can see that here. As you know by now, the dark green is an increase over the past month and light green is a decrease. Most of the UK has decreased across the UK with the exception of the east of England, which has been in beast mode for the past 12 months. A year-on-year change basically is a price today compared to the same price this time last year. Everywhere across the UK is up on last year. So don't lose sight of the bigger picture. It has been a really strong year. This past month is seasonal. It's to be expected. It happens every year consistently, as we saw at the beginning of this video when I showed you the numbers from the HM Land Registry. Overall, pretty much every region has had a strong year. Northeast, a bit weak, 1.9%, but the average across the UK is 10% for the past year. So, you know, Southwest very strong, Northwest where I invest very strong, East of England, Southeast, even London, which is traditionally very low, has had a decent year at 2.7%. It's still grown. Come on, London. So let's come on to what I think is going to happen in 2022. We're at the end of the year. What's happening next year, guys? Let me know in the comment section below what you think is going to happen in 2022. So guys, in summary, I think that next year we're not going to see another year like this year, unless of course another global health pandemic happens. But I think we're going to have a strong year. I think it's going to be above average, above the average of 5.6%, but not as high as the 10% that we've seen. If I have to put my hat on it and make a bold prediction, I would say around about 7.5%. And you can hold me to this time next year, when we get to December 2022, you can replay this segment of the video next to me and see if I'm right or wrong. I will fall on my sword. Why do I think that? Well, I think, guys, that demand is evening out. It's evening out. Last year, demand was crazy. It was on steroids. But I think it's now evening out, and I think that next year supply is going to increase, and that's going to keep the market going. Why do I think that? Well, two reasons. Firstly, let's go back to this graph. Average time to secure a buy, which is a proxy of demand, evening out since June, right? It's been at a stable level. Demand has been at a stable level. Now let's look at some other information which I think supports this also. Number of mortgage approvals in the UK. Again, this is a proxy for demand. It's the amount of people that are applying for mortgages and getting those approved. Since November 2020, back end of last year, we saw a peak at 103,000, and look at this, it has come down to 72, 103,000 down to 72,000. So over a quarter, those approvals at this peak have fallen away. Now let's look at a longer term view. This is a 5-year view. Interestingly, so this dip here is when the global health crisis started, so around about March 2020. Before that, for the last 3 years plus, we have been round about, that's about what, the 65 to 70,000 mark, been very steady, guys, consistently, round about 70,000 mortgage approvals per month for the last 3 years before that. Entered the virus and we dipped down to less than 10,000, guys. And then interestingly, you see this hike up to 103,000, way above what we ever saw before. Why did this happen? Well, let's think about it. So you go from an average of 70,000 people wanting a mortgage per month down to less than 10,000. Those people still want mortgages. There might be backlogs of people who were applying for mortgages, but because we saw this pandemic, people are being laid off from jobs, business operations are being disrupted. So you're seeing these piles of mortgage applications stack up on businesses' desks, but they don't have the buildings, they don't have the staff. So as operations kind of get back to normal, you see this spike. And this is basically the mortgage market recovering. All of these backlog mortgages are now being processed. So you see this spike up to 103,000. And as those backlogs are cleared, the number of approvals comes back to its long-term average. And let's go back to the 1-year view of, surprise, surprise, 70,000 per month. So I say all that, guys, to say that I think demand is going to stay the same, but supply has a bit of work to do. So we see here that over the last 12 months, supply has been at an average of 66 properties per agent versus 46. So that's 43% higher. So overall, guys, I think that demand will stay close to what it is now, and supply will increase, and that will push the price up continued into next year, but not at the rate that it's been over the last 18 months. So that's why I'm hanging my hat on above average, but in between the unprecedented peaks that we've seen lately. I'm not convinced that we'll reach that, but again, let me know what you guys think in the comment section below. And then I wanted to end, guys, by showing you two really cool things that I found. Well, one is a cool thing that I found, and the other is some news. The first thing is some data from Nationwide Building Society. Now, for those of you who don't know, Nationwide is one of the biggest mortgage lenders in the UK, and they lend a lot to first-time buyers, and because of that, they can produce some really cool data and metrics based on all of the people that they supply mortgages to. So the two ones that I want to show you is firstly first-time buyer mortgage payments as a percentage of take-home pay. So this tells you how much of your take-home pay you spend on your mortgage, depending on where in the UK you live. Now let's take a look at these. As you can imagine, to this day, London is an absolute black hole when it comes to living expenses. I want to draw your attention to the red lines here because this is the most recent number for the period. If you live in London, you are spending 55% of your take-home pay on average on your mortgage. The struggle is real, guys. Outer metropolitan area, so that's the area just outside of London, again, is high, as you can expect, because it's close to London at just over 40%. And the next highest is the southeast and the southwest. Clear pattern here, guys. As you come further south towards London, the higher your living expenses are. And then as you get further north towards Scotland, you know, Scotland's the lowest. Living expenses as a proportion of your take-home pay get less and less. Let's have a quick look at northwest. I'm always interested in the northwest because that's where I invest. On average, you are spending around about 25% of your take-home pay if you live in the northwest, compared to London, almost, or less than half, guys.
How, Soyb?
And that's one of the main reasons why I live in the northwest. when it comes to the amount of money that you're going to pay on a buy-to-let mortgage if you're investing in the Northwest compared to London, it doesn't compare, guys. And also don't forget, when you work in London, you get a London weighted salary. When you think about it, it makes much more sense as a Londoner, for me personally, to invest in the Northwest because I'm getting a London weighted salary, but the cost of a mortgage in another region of the UK is significantly less, and that's why I invest towards the north. It's simple maths, guys. It's a no-brainer for me. And then this is a similar graph, guys, but it is, instead of being given by region, the amount of your take-home pay that you spend on mortgages is given by the type of job that you do. And I just thought it was quite interesting to look at. Basically, the shorter the bar, that is the less that you pay of your take-home pay towards your mortgage. Interesting graph to look at, interesting information to interrogate. And there's lots of other graphs you can look at, guys, but the most interesting one that I found, and this is really useful for me when I'm buying properties, and that's affordability. So affordability is how many times your salary does the house cost. So for example, if you're earning £30,000 and you're buying a house for £300,000, it's going to be 10 times your salary. Generally speaking, lenders in the UK try to limit lending to less than 4.5 times your salary. So let's select one of the most expensive areas in the UK, Kensington and Chelsea. Look at that, wow. So if you are buying a property in Kensington in Chelsea, the most recent year is 2020, on average, the average house there is going to be almost 17 times the average UK person's salary. So basically, you got to be earning mega bucks to live here. And then let's compare that to Liverpool, the city. I mean, look at the difference, guys. We're talking about 3.5 times the average person's salary compared to 17 times. And as I said, guys, this is a really useful tool because you can compare different areas of the UK. Looking at this, it's just a rough idea of how expensive it is. Obviously, not everybody earns average wage. Some people earn above it, some people earn below it. But if you use this as kind of like a guide. So guys, speaking of affordability, I did a poll not so long ago on my page, and I asked how many of you own a property and how many of you are looking to buy a property in the next 12 to 24 months. Most of you said that you don't own a property, but were looking to buy in the next 12 to 24 months. So I developed a tool that automatically calculates numbers like your affordability. So it's going to give you the affordability number based on your wage that you put in. It's going to tell you if you're likely to pass or fail a mortgage. But not just that, guys. It's going to give you a ton of other really useful information. It's going to tell you how much your property is likely to be worth in the next 7 years. It's going to tell you how much profit you're likely to make if you're using that property as a buy-to-let investment. It's going to tell you your yields, your return on investments. It's going to compare the price of your property to the average property in the UK that's the same type, and a lot more. So check it out. The link's in the description below. It's a really useful tool that I use for my investment properties when I'm assessing them. So guys, that is the last update for the year. I hope you found this useful. Guys, let me know in the comments section below how you've been finding these over the course of the year, and if there's anything else that I can add to these to make them more valuable, more useful to you going forwards in the new year. Have a good Christmas, guys, and I'll see you in 2022.